Hello, I'm Alec Hogg, and as you can see, my colleague Stuart Lohman is with me, both of us with very nice fancy headphones, and we both need a haircut, I think. But here we are at the, well, we've been doing it every 2 months, but in future we're going to be doing this webinar every month because given the number of attendees that are coming to the webinar on the portfolio, and the fact that there, I think, are now 10,000 people who are customers or investors at the Standard Bank web trader, and a lot of those people are also interested in the webinar. We're going to be doing an update every month. Of course, it's such a pleasure to be doing it this month, Stu. The numbers are just gangbusters. But anyway, yeah, maybe you can give us some background, because I'm sure there are going to be a lot of questions now that the portfolio has just surged so much. Should we be selling, etc.? And let's make sure everybody's actually hearing us.
Excellent, thanks. I think the numbers are quite not surprising, just quite over the ahead of expectations even. Just quickly, if you can see Alec and myself on your screen, and there's a little Gangbusters for Exponential Stocks presentation below. Can you just give us a high five? There we go. Got some high fives coming through, the virtual type. And we do like to keep it very conversational. I'm sorry, I think the dog got to go there. Just with the questions drop-down menu on the control panel there. If you put your questions in there, I'll pass them on to Alec as he goes through the portfolio. But we do like to keep it conversation as well, so please don't hold back as they come to mind. But let's go, Alec.
Well, I'm glad to hear that you've also got dogs who interrupt. My Jack Russells, if they weren't sitting right on the other side of the house, would definitely have made an appearance. But anyway, let's go into this portfolio because it is quite extraordinary. I've just pushed the volumes up a little bit, so hopefully those the sound is coming through a lot clearer. So we'll know that Stuart, you'll be monitoring the questions and interrupt me as per we go along, but hopefully the sound is fine and everything is coming through loud and clear with you now. Okay, so let's get into the beginning of what happened. If you recap, and it's a bit of a recap, going back on the 25th of March, you might recall that we sold 100 Berkshire Hathaway shares at $178. That share price, incidentally, is now $174. So if you didn't sell in March with us, you can still do that. You can still sell them now and reallocate the investment. What we did at that point in time was we're starting from the top here, from the US side. The whole idea of our US portfolio is that we buy our shares over 3 months. So we'll buy it first tranche month 1, second tranche month 2, third tranche month 3. And there we bought, you will recall, 32 Spotify shares and Cloudflare shares. As you can see, those were the prices. So that was 1/3 of the cash that came from the Berkshire Hathaway investment. On the JSE, when we invest here, when we purchase shares, we buy them in bulk. And the reason for that is that there's no exchange or foreign exchange exposure. The reason why we do it a little more, well, we stagger the purchases on the US side of the portfolio is because of foreign exchange movements. We don't really want to have take a risk on both sides. You might be buying when the rand is particularly weak, or hopefully when the rand is particularly strong, but you don't really want to gamble with that. What you want to do is to try and take the rand out of the equations, whereas on the JSE, the rand is a constant. So what we did there was we sold that ETF and then bought into Discovery and Sasol. Look at that, seriously. Those were the purchases that we made. Sasol at 28 Rand and Discovery at 67 Rand. In fact, Sasol actually went down after this. It got to as low as 20 Rand a share. Incredible to think now, but I am trusting that if you follow the portfolio, you did exactly the same. Subsequent to this, so what's happened between the 25th of March and the 25th of May, we have obviously been purchasing Spotify and Cloudflare, the 2 shares. And you can see what has happened to those share prices. Spotify, we only got 22 shares because the share price had gone up compared with 32 that we bought in March for the same money. Cloudflare has also gone up from $22 to $28. So in a way, by not buying all of the shares in the US at the same time on the 24th of March, we have been a little punished, but we did take the exchange control issue out of it, and it is something that we've done in this portfolio all the time. But you can have a look there at the bottom. The total purchases then for the changes to the portfolio is Spotify at $148 and Cloudflare at just over $24 a share. Both of those, obviously, because we've just bought the final tranche. In fact, we did it at Friday's prices in the United States. The markets were closed yesterday because of Memorial Day. The prices that we got them at yesterday are much higher than the average price that we paid. So all good news as far as that change in the portfolio is concerned. This, though, is just, it's blown me away. And I don't think I don't think you can really script this kind of thing. As you can see, on the 25th of March, the portfolio, which began at a rand value of 2.25 million in 2014, was already sitting at 6.7 million. It has had an incredible increase in the last 2 months, and it's now sitting at 8.7 million. That's primarily because of these are the issues. These are the reasons for it. Amazon has added 445,000 Rand in value. Apple 330,000. Sasol, which we bought at 28 Rand, has already given this portfolio almost a 300,000 Rand boost. Naspers 182, Discovery 180, Microsoft 168, Adobe 161, and Netflix 130. Quite good news as well as far as the other two stocks, the new stocks, are concerned, because they've both gone up. The only laggard has been Richemont. So just to go back to the portfolio, as you can see it there, the investments that we made in Amazon going back to 2014, in fact, it's the only stock, interestingly enough, and we haven't done a lot of changes in this portfolio over the past 5.5 years. The only stock that's still there from the outset was Amazon, which we bought at the time as 8% of the portfolio. But of course, the share price from $327 to $2,400 has made an enormous difference to the value. And in rands, it's a 10-bagger. It's up 1,000% in less than 6 years. So when you get a 10-bagger in your portfolio, it doesn't matter where you find it, it is going to make a huge difference to the performance. And a similar thing there with Sasol. We felt that Sasol at 28 Rand, 27 Rand plus commission, was a absolute steal because of the market value, the market capitalization of the stock, and clearly at 77 Rand, we're looking very clever. Of course, there were a lot of people at the time who felt that Sasol could actually go bankrupt. I'm going to talk to that in a little while as well. Obviously, we disagreed. But what's quite interesting to see is that Discovery, phenomenal company, which has big assets all over the world, when we bought it in March for this portfolio, it was sitting at 67 Rand. And it's actually gone back above 100 Rand recently, but the most recent price this morning was 98 Rand. So there we go. And you just don't get these opportunities that often in 2 months, a 46% growth in that in the value of the shareholding. But the big ones, Apple and Amazon, giving us huge returns there. Both of those stocks went up very strongly, and I'll talk to those in a moment as well, in the past couple of months, as the world has moved dramatically towards fourth industrial revolution. I was reading this morning in preparation for this, the latest conference call, investor call rather, by Cloudflare, the chief executive, Matthew Prince, and we'll talk to him a little bit, or talk about him a little bit later. And he was saying that what Cloudflare does, incidentally, is it protects websites. It protects the internet. So it's a very, very strong shield. We use it on Biznews. We had a few hack attacks in the early days of this company. And since we put Cloudflare there, we've had a couple of more attacks, denial of services, etc. But it's lovely talking to these fellows, because they are so excited when there is a challenge from a hacker, and they really jump into action. And you can just see that it's a kind of company that is extremely well poised for the world that we're going into the future. And the world has moved dramatically online. Cloudflare, he says, has had more traffic in the internet, and they do protect many websites, most websites. I think they're the dominant player in the world. they've had as much traffic in the last 12 weeks, growth in traffic in the last 12 weeks as they had in the previous 12 months. And we've seen something similar at Biznews as well. So it really has been a dramatic move towards the online space. The rebound, though, in our portfolio has been spectacular, as you've seen, but it hasn't been alone. On the left-hand side, the S&P 500 index from its lowest point is up 31%. The NASDAQ, where the tech stocks are, was up 36%. And our stocks, our holdings have actually done even better than that. Just to look at the annualized return now, and this is incredible, it's 54% per annum since we started on the 5th of December. Now, I guess some people will look at this and say, goodness me, if I look at, if I extrapolate that into the future, then you would be, well, you'd kind of be outperforming just about everybody else. But that isn't the intention here. We're not saying that the future is going to be a better return or anything like the 54%. 54% a year for 5 years, you can almost sell everything and just sit back and wait for the next 10, and you've still done better than pretty much all investors. What we've decided to do, though, is to give you ideas, give you suggestions, and to update on a monthly basis now and going into the future how those companies in the portfolio have been operating. As I've often said, the great advantage, the biggest piece of luck that I had was being a digital pioneer, starting MoneyWeb in 1997 at a time when the digital world was very, very young. And when you are immersed in a particular field, it gives you the opportunity to learn on the job. It's a little bit like an apprenticeship, on the job training. And as a consequence of that, for me, a number of these stocks that are now becoming mainstream investments, if you like, just seemed absolutely obvious because of the way that the world was moving. And that has been put to great advantage in this portfolio. So individual stock performances, there's our 10-bagger, Amazon, but the rest have also performed extremely well. See Sasol, the advantage of buying it at a ridiculously low price is up. Well, it's already the 4th best performing share in our portfolio, and we've only had it for 2 months. Discovery is a little more modest, relatively speaking, but even better than Naspers, and those we haven't had for long. And Spotify and Cloudflare we've only just put into the portfolio. The disappointment is Richemont, and if you are an aggressive investor, and we might well be selling Richemont next month, I just wanted to settle down the purchases that we had, but I'm quite keen, in fact, to switch from Richemont into one of the construction or a couple of the construction shares. I really like Afrimat and I really like Wilson Bailey, but we'll probably do that change next month. But if you are an aggressive investor and you would like to move along, well, Richemont has been a drag on the portfolio. Reading through what the chairman Johan Rupert had to say with the most recent results, he's not terribly optimistic. He's really positioned the company unbelievably well. They've got a lot of cash in the bank. They went and borrowed a whole lot more money on a bond as well. But the new normal cannot be like the old normal, where the richer you were, the more you flaunted it. It looks like the new normal is going to be a very, very different world. And as a consequence, Rupert is pretty sensible when he continues to say that although they've done everything they can for Richemont to position it in the right way, the future is not quite as bright as it was, as the past was. And I take him at his word there. And when I look at the future for South Africa, there's only really one thing that's going to get this country out of the doldrums, and that's a massive construction boom. So let's look for the stocks that will benefit from that. And these are the big swings that sometimes you need to make a call on, but not for for today. It's for the next one. Stu?
Thanks, Alec. I've just put that Richemont article on the chat group there because it's calls an end to the luxury bulls, Rupert, in that article on, as you're talking about the Richemont there. So we just got a question on Amazon, Alec. Jaden Thompson asks, would you still be buying Amazon at these prices?
Yeah, Jaden, and there we go. That's the next slide. And let me just have a look at this, and I'll give you a little bit of background. A couple of very interesting things came through about Amazon this week. There's the performance of Amazon during the wipeout. So I took it pretty much from the bottom, and as you can see, the black graph, and this, you're all Biznews Premium subscribers, so you can get these graphs on WSJ.com. Just go to Wall Street Journal, WSJ.com, and put in AMZN or Amazon, and you can then play around with the graphs and have a look at all the financial data as well, and lots of news stories. But what I've done here is I've taken the NASDAQ against Amazon, and you can see the outperformance here is about 20% since the bottom of the market. Now, why is that? When we look back at Amazon, which has been around since the mid-90s, so it's one of the earliest of the internet companies, and it is clearly one of those that has been very sustainable and continued to grow. I was reading a book, I wrote about it this week, called That Will Never Work, which was the story of Netflix in the first 5 years, written by Mark Randolph, who was the co-founder and the first CEO. He gave way to Reed Hastings, and he readily admits that had Reed not taken over, then Netflix wouldn't have been what it is today. But in the book, one of the interesting parts of it is the visit they made to Amazon. And Bezos asked Mark and Reed Hastings, when they were tiny at this stage, Netflix has hardly even begun, to come and see them, to come and talk about maybe selling Netflix to Amazon. At the time, they were terribly worried at Netflix that Amazon would be going into the market that was their biggest market. At the time, Amazon wasn't into DVDs. This is before streaming came onto the internet. But it was already very clear that Amazon was going to be the giant, and this is in the late 90s, the giant in the online space. So Reed Hastings and Mark Randolph went to visit the Amazon offices. They described them as being in the most unsalubrious part of town, in other words, very, very down market, where there were drug dealers standing on the roads and kind of doing their trafficking. It was a real grotty area. And the Amazon building itself was in a very low budget place. And that speaks a lot to what Bezos has believed from the beginning. And I'll elaborate in just a moment on that. But Bezos was saying to them that Amazon would like to get into the sales of DVDs, which had then started to become a market. At the time, it was 97% of Netflix's revenues were through selling DVDs, not through renting DVDs. But it got Reed Hastings and Mark Randolph to understand, or to change their path for Netflix, because if Amazon comes in, they kill you. So they, at that stage, gave up on selling DVDs, which was already 97% of their business, and they went into the rental business. And of course, from rentals, they've become streamers, and Netflix is a great business. But it was just really interesting to see how Amazon had started and how they'd always had this parsimonious idea. The second point was I was listening to a podcast from Steve Parrish from Farnham Street, where he interviewed Jim Collins. And Collins is the author of 2 amazing books. If you want to learn about business, I would suggest, or investing, I'd suggest you read both of them, Good to Great and Built to Last. Now, Good to Great is all about the companies that come into the market as disruptors from the beginning. And he said that he wrote this book, and it was just after 9/11. He was invited by Bezos and the Amazon team, this is Collins, to come and teach them. They wanted him to teach them about the thing called the flywheel. And he said, the way Collins talks about the flywheel is you start getting a flywheel is really another word for momentum. If you get the momentum going in the business, it feeds on itself, and eventually you just get this gigantic organization as a consequence. And he said where the difference was from all the other people who had approached him and asked him to talk about the flywheel with Amazon, they said, teach us how this works and then help us to understand. We'll tell you what our business is about. Help us to understand what we should be plugging into the flywheel. We want our own flywheel. And he said that even at that stage, this is in 2001, Bezos was completely committed to a business process, which was that you will give the best prices possible to your customers. So you put your customers first, which means the action is give them the lowest possible prices, which then gives you the ability, well, that would then attract more customers, more users. You then can go to companies and ensure, because you've got a bigger base, that they will give you a higher discount, and you feed that discount straight back in to the other part of the flywheel, which is to make the prices lower still for your customers, and you get this virtuous circle. It's a really good idea to go and listen to that podcast of Jim Collins being interviewed by Steve Parrish, and you'll see there why Amazon is an exceptional company and something completely different. It can, from time to time, the share price can be a little too high or a little too low. But if you're looking for a share that you can put in your bottom drawer and just not worry about it, because they don't care what the rest of the world is up to. They've got their own flywheel. They've got their own focus. And what a wonderful model. It's a little bit like the Discovery model, which is actually a shared value model. If your customers can benefit from what you're doing for them, then you will benefit as well. And then as long as you keep feeding back into that circle, it's very difficult to stop that flywheel from turning. And I think Amazon is a variation on that theme of the new age, and a company that certainly you can buy anytime. If you are buying it today, if you haven't bought the shares yet, Jaden, I would suggest that maybe you buy them in 3 tranches. So if whatever money you've got to spend, you break it up into 3, and you buy the first third and the second third and the third. First third this month, second third next month on the 25th, as we've done with both Spotify and Cloudflare. But thanks for the question, because it actually fitted in really well with the presentation I've got here. Stu?
Thanks, Alec. There's just one on RSA stocks. Philippe says, why are we investing in SA stocks considering the uncertainty around the economy? Or does exiting the top 40 address this concern?
Yeah, Philippe, it's an interesting question, but let's just go back and have a look at what stocks we've invested in. We did previously invest in SA Inc. I'm so glad, and that was through the exchange traded fund. I'm so glad that we're not there anymore. The 4 shares that are there, Naspers is not a South African stock. Naspers is actually an investment in Tencent in China. It's, last I looked, 140% of the value of Naspers. So if you were just to, you're basically buying Tencent for a 40% discount. That's what you're doing with Naspers. In fact, I saw it starting to make some of those commentators on Motley Fool, or what happens is at Motley Fool, the website, and it's a really good website to get ideas from. They have various asset managers and commentators who go and put, my 3 best stocks for the next decade. And Naspers is starting to make those comments as well. So it's starting to be looked at now by the international community, not surprisingly, because it's a very cheap way into Tencent, and Tencent is a phenomenon in China. The second one we have there is Richemont, which really I don't think it has any businesses in South Africa. Then you have Discovery, which has a substantial business in South Africa, but its benefit or its excitement to me is on 2 bases. One, it's a shared value model here in South Africa, and 2, in that it has taken this shared value model globally and done a lot of transactions and partnerships with many companies around the world, including, as we said in the last webinar, in China, with Ping An Health, which is not the Ping An Health that is listed. So don't get all excited when you look at the Ping An Health, which is listed, that Discovery's got 25% of, and then extrapolate the numbers as I did, and said, crumbs, you're getting Discovery for free if you get the Ping An Health. It's a different Ping An Health. Don't ask me how the Chinese work or how Ping An works, but I think the one that's listed is called Ping An Health and Technology, whereas Discovery has 25% of Ping An Health. But still, that is a huge company already and really mushrooming. And the final one was Sasol. which is not really a South African company anymore either, although it does generate a lot of its income here from the rand oil price, which again, if it's a wonderful rand hedge from that perspective. Much of its assets are outside of the country's borders, as we know, the ill-fated Lake Charles chemical investment in Louisiana. And however you want to look at it, at 27 rand, it was just ridiculously cheap. So no, I'm not going into the South African market and buying SA shares. It is just too dangerous right now. In our webinar yesterday, Piet Viljoen put the chances of South Africa going along a Venezuela/Zimbabwe route at 20%. Now that's very, very high. That's like going to the races and you've got a 4-to-1 shot in the race. You don't ignore that horse. It is something that you really have to take a cognizance of. And if we're in that situation, although investing in the JSE in these stocks, you are buying in rands, you are buying foreign assets. So I think that hopefully, Philippe, that gives you the rationale.
Thanks, Alec. Doe just wants to know, I know it's a virtual portfolio, but he asked, how do I find this portfolio on Standard Bank Web Trade? I think it's a good place to start on how it works, Alec, the portfolio itself.
Yes, let's just go back there, Doe. This is, we started this in 2014, a little bit of history. The intention there was WebTrader had just begun. We as Biznews were a very young company. We'd only been around for a year. And Brett Duncan, the CEO of Standard Bank Online Share Trading, said they wanted to find a way of promoting this. So we began it as a virtual portfolio on the understanding that we would do a monthly update. A couple of years later, the guys at Easy Equities got chatting to us and said, look, you've done so well in this portfolio. Why don't you have a real one? And we did. We started a thing called the US Exponential Portfolio there with Easy Equities. And it performed as just like this one has, unbelievably well. As a consequence of that, money started flooding into it, as happens. And after not too long, there was so much money in there that I started getting nervous that it was now looking after people's savings, which was never really the intention. I suppose I should have thought it through more carefully when we began. But we then said to Easy Equities, look, let the professionals do the trading and do the purchasing and sales for you. I can't. I'm not a money manager. I'm a journalist. My investment, my time is put into my business, which is Biznews. And this really is a way of enabling people, enabling our community to understand or better understand the opportunities that are available offshore. And if they buy into the shares in this portfolio, we do a certain process of them, and then we keep updating them. So we can see whether when something's starting to go wrong, or not we can see, but we hope to be able to observe that. And we've had a few instances of that where we did see things going wrong at Metro Bank, for instance, where we sold at £30 a share and they're sitting at 72p today. But that was due to the scandals that had come out of that. So the problem with investing is often you're told to buy and hold forever, and that is true, but you've got to keep looking. If you've only got a few eggs in your basket, you've got to keep looking at those eggs and making sure that those eggs aren't going rotten. And that is really what this is about. So every month we have this update on the portfolio. It's up to you to decide whether to follow us or not. It's what you do if you follow us is that you know you will get some feedback on it, and certainly you'll be given insights into when to sell the shares. I remember with Easy Equities, we also did a South African portfolio called SA Champions. It was a very difficult one to do because we only had a small group, a small universe of shares, and amongst them was Blue Label. And Blue Label then got involved with Net1, and the smell from the scandal was getting intense. And it said, I got them out the portfolio because of that scandal, just following Warren Buffett's principle that there's never one cockroach in the kitchen. And even 3-4 years later, someone came back to me and said, why did you tell us to buy Blue Label? Well, at the time, it looked like a pretty good bet. But then when the cockroaches started coming out, you needed to sell the shares. And that's really what this is about. If you are going to follow this portfolio, please follow it. Come on to the webinars every month. Have a look at what's going on, because we will be making changes to this portfolio. I've already signaled the Discovery and Sasol change about 2 months before we actually did it. And I've already signaled that we will be selling Richmond and buying into Afrimat and Wilson Bailey Homes at the next portfolio in a month's time. But it doesn't mean that if you just buy these shares and forget about them, that they are going to still be serving you well into the future. So it's a model portfolio where you get updates every month. And I hope that clarifies it for you.
Thanks, Alec. You mentioned Amazon. Anthony just wants to know, are the USP ratios not too high at the moment? I know you don't really look at PEs, but just a question on that.
We always hear that. I think the place to start is to have a look at exponential stocks. And if you start putting in exponential growth into your spreadsheets and look at you start with intrinsic value. What is your intrinsic value for a particular company or for the stock of that company? And would you be a co-owner at that rate? I'm not saying that at $2,400 that Amazon is the cheapest share on the market, but in 5 years' time, when we look back, it might have proven to have been one of the cheapest shares on the market. According to my intrinsic value, and when I do the growth or the exponential growth into the future of this company, it's one that's going to be around while a lot of other businesses have actually departed. So I think you need to get your head around what exponential growth is, what the fourth industrial revolution is, how the world is transforming and changing as a consequence of it, how COVID-19 has accelerated that process. And if you start thinking along those or reflecting on those issues, you'll realize that things like PE ratios in many instances mean nothing. I mean, PE ratios of South African banks are 4. You buy them on a PE ratio of 4. So are you going to rush out and buy South African banks? No, of course not, because that is a historic profits. When you look into the future, well, the profits might be very different. And those are the parameters. The old days of being able to use price earnings yields or even dividend yields as a guide to just go and buy blindly, I think are over because we are in a transitional world at the moment.
Exactly. You mentioned banks there. Miles asked the question, you said a P of 4. He says they're trading on 10-year lows. Why aren't you interested in them, or will you look at them in a few months?
South Africa is just too high risk at the moment. The South Africa Inc. is very, very high risk. I don't know. We don't know whether we know that what the government did for the first 3 weeks of the COVID-19 crisis was good. Remember, I'm doing this Inside COVID-19 podcast every night. I get to speak to a lot of people, and so does myself and my colleague Linda van Tilburg, and we put that together every day. And as a consequence of that, we kind of close to not the sensation, but to the rational thinking, like Professor Michael Levitt, the South African Nobel Prize winner, who's the professor of computer science and structural biology at Stanford University. So he runs 2 departments at the greatest university in the United States, or the one that is rated highest. And he reckons that, lockdowns are not very clever because the consequences thereof for the economy are a lot worse than anybody seems to have thought about. So the first 3 weeks of the lockdown, good stuff. I'm on the side of Panda and the analysts there, the actuaries, who've shown that the damage to the economy as a consequence of the extended lockdown is going to be so vast that to get out of it is going to take years, maybe a decade. And as a consequence of that, if you are buying a company, and banks, remember, are reflective of the economic performance of a company, of a country rather, then we don't even know what's going to happen yet. But what we do know is that it's not very pretty. And as a consequence of that, I wouldn't be buying into South Africa's economy right now because let's see what happens. Let's see the bold plans. Let's just take a silly thing like the motor industry. In South Africa, we have got this legacy from the past where we subsidize motor manufacturers, international motor manufacturers, by putting a duty of 100% on any motor vehicle that comes into the country. And we as taxpayers subsidize this whole industry. Now, there are many arguments for it, and the government will say yes, but it employs however many thousand people as a consequence. And without having these subsidies, we wouldn't have these companies in South Africa, the motor manufacturers. But it's still beggars belief, if you're going to restructure an economy, that you've got, 7 international motor manufacturers who are sitting here with relatively small plants who are being subsidized by the South African taxpayer. And that's like a holy cow that hasn't even been looked at, let alone South African Airways, AXA. If we see Ramaphosa starting to do the stuff that we know we as a nation are capable of doing if we just get the right direction, then I'll be the first person to jump back into South Africa Inc. But right now, what I'm seeing is confusing and concerning, and the consequences of COVID-19 have got to say to you, would you be buying this economy right now? It is just too much risk, and there's just too much uncertainty. But let's hope that Cyril keeps listening to the scientists and to the people who can show us the path forward, because we know we've got lots of potential here. It's just we need the direction. I hope that helps.
Thanks, Alec. There's Anit wants to know about the portfolio construction. She says, do you limit the percentage contribution of individual stocks to the overall portfolio? Example, Amazon's now 25% of the portfolio. And which ones are you looking to increase if you do?
Oh, it's a good question. We started it off in 2014 as having 3 anchors and then 5 wild cards, we call them. So we had the 5 wild cards were 8% each of the portfolio. And then as the anchors, we went with 3 companies that were solid, including the S&P 500 index. So we had S&P 500 index and Berkshire Hathaway, and what was it? It was 20% each in 3 companies. Can't even remember the third one. Sorry, it's a little while ago. And then we had 8 what we called wild cards. Now, the construction of this portfolio is a consequence of 2 things. To start off with, the beginning, how we had it at that point in time, and secondly, the philosophy that when you buy a share, your intention should be to hold on to it forever. And that has been the intention here with all of these stocks. For instance, the 84 Spotify shares that we have today, although they're only making up 3% of the portfolio, they're intended to be held forever. You can look at Sasol. Sasol, because of its dramatic increase, is already 5% of the portfolio. That's quite comfortable. I don't believe that when you buy any share, you should be looking to trade it. It is the best way to do it is to actually find a stock that you understand the story about, that you are prepared to hold forever. And indeed, if that's the case, do hold it forever. There have been many times over the past few years where we've had people suggesting, well, why don't you take profit on Amazon? Imagine what would have happened had we done so. Similarly with Microsoft, Apple was underperforming for a period of time. As you see, we bought it at $124. It was down at $90 for quite an extended period. But we understood why we were going to buy it in the first place. We understood the flywheel, if you like, of those companies. So the construction of the portfolio is such, it's a relic of history and also a consequence of the performance of the individual stocks that we have.
Thanks, Alec. Ed just wants to know, what's your view on working from home and online, and which US shares would you investigate?
Ed, we've been doing it at Biznews for 4 years. Our Chief Happiness Officer, Jeanette, is an expert at remote working, and Stu will be able to support that as well. But it needs working from home or being online. It's not that simple. You don't just flick a switch and say, okay, everybody, you go home, and everybody starts working from home. It is like most things, the devil's in the detail. I believe that at home, you were put in, and this was something I picked up from Alexandra Samuel. You can go and listen to that podcast, fascinating podcast. She's a doctor from Vancouver, and not a medical doctor, but a doctor of psychology. And she wrote a piece for the Wall Street Journal, which was their top read story, where she explained how to work from home. It might seem pretty obvious, but it isn't. And she said that, and she's been doing it for 22 years, she said that when you spend 5 hours at home, it's the equivalent of 8 hours in the office. And what tends to happen a lot is that when people are at home, they tend to work more than they would at the office, which then brings on things like burnout, it brings on grumpiness, it brings on all kinds of other issues, psychological issues. So it isn't that easy. What Jeanette does is that she makes sure that every member of our team, our Biznews team, is actually connected, that they know where we're going to. We have regular engagements. We use Slack. There's lots of little things that need to be thought about. So that would be my view of working from home. Is fantastic, but you do need to have an office for the social side because we are social beings. And we have an office at WeWork in Sandton. And although we've been allowed to go back, being an internet news company from level 4, we haven't been. We will, though, start seeing each other a bit more from next month in June when the country gets back to normality. But there's no way we're all going back to work from, or that we would work from WeWork, because that's just not our culture. I think that the working from home philosophy has been embraced. Who are the companies who will benefit? Well, there they are in your portfolio. Netflix, an obvious one. Spotify, an obvious one. Cloudflare, an obvious one. You would, just to unpack those three quickly. Netflix, well, when people are at home, they tend to watch movies more. Spotify, when people are at home, they tend to listen to music more. And Cloudflare, when people are at home, they use the internet more. And Cloudflare is one of the best bets you can have on the expansion of the internet. Then Amazon, you easier at home, so you'd order in. Microsoft has got its software, which is well positioned. Apple, Adobe, they're all of our companies, US companies, are focused towards this massive trend towards digital and the work at home. So it's not surprising to see the portfolio having done what it's done in the past 2 months. I would just stick with these. I know these companies because some of them we've had in the portfolio a long time. Every morning when one of the first things when I start work is I'll go through each of the businesses, the updates on the businesses, and just keep in touch with what's going on there. And all of these are Fourth Industrial Revolution companies whose time has come.
Thanks, Alec. You mentioned obviously Amazon's strength. Harry wants to know, what about Shopify in Canada?
I've heard about that a lot, Harry. It's not one that I've investigated. I just haven't gone in and done any research on it, so I can't, I'm afraid. But if it's like NVIDIA. Quite often in this, in these webinars, NVIDIA's name has come up, and it's just not a company I haven't gone in and done the research to understand it yet. But I think I need to. It's been a fantastic performer. I don't know Shopify. I've looked at it, very cursory, but no comment. Too hard for me. Warren Buffett says that there are 3 piles on potential investments. He said the first pile, or on his desk, he's got 3 folders. The first folder is very, very thin, and that's the folder on companies that he's looking at to invest in. The second folder, he said, is quite a bit bigger than that, and that's companies that he wouldn't invest in. And the third folder, he said, is just fat as anything. It's by far the biggest of the 3 folders. And he said those are the ones which are too tough to call. And I think that's really when one makes an investment, you just got to be sure that you don't take a chance there, that it's too tough to call. But I think for me, Shopify is just too tough to call right now.
There's just two questions on the same topic of Alibaba, Alec, and the effect, the Hong Kong effect, obviously with the Chinese movement there.
Yeah, we liked Alibaba a lot. In fact, it was in this portfolio. And then when Trump started getting pretty angry with China and the Alibaba being listed on the US market, we saw it shouldn't happen, but we saw the impact on the share price. And it just seemed like a sensible thing then to, despite liking the company a lot, to look at it differently. Of course, the departure of Jack Ma cannot be underestimated. He's only one guy, but he has been the driving force and absolutely brilliant entrepreneur. I'm sure there's just as good entrepreneurs who continue there. But if Pony Ma were to step down from Tencent, I think I'd look at Naspers differently. And as a consequence, that was one of the things with Alibaba. Problem for Alibaba going forward is that Donald Trump wants to get re-elected, and that means between now and November, this Cold War, which has broken out between the US and China, is not going to get any warmer. The big thing that's now being talked about because of the COVID-19 pandemic is that if the US were to get a vaccine that works, the last country it would allow to have it is China, and vice versa. If China gets a vaccine that works, it would do the same thing to the US. In fact, Trump is apparently, the political commentary anyway in the United States says that he's really betting heavily on the US bringing out a vaccine by November so that he can go to the Americans and say, you see, China gave us this terrible virus, but we, America, have saved the world. And that's kind of going to be his stumping ground for where things are at the moment. In that scenario, a Chinese-based company that's listed in the United States isn't one that's going to be in a happy place.
Mike's got a question on the JSE again, Alec. He says, based on the high SA Inc. risk, it would seem that one should sell local equities, take a hit, and invest offshore or move into bonds and cash.
Michael, be careful on that one because many local equities are already offshore equity. And as we mentioned in our portfolio as well, be very, very cautious about that. I'm quite excited about the construction sector, for instance, because if the construction sector in South Africa isn't targeted with the new change or the strategic approach, then we really haven't got a chance. So at the very, very least, construction is going to be one sector in the South African economy that would do well. Also, when you have a look at the bottom end of the market, Shoprite, which serves Pepkor, Capitec, those are companies that are extremely well positioned, but it's priced in. It's completely priced in. And the reason why they're well positioned is if you have a look at how big the social grant percentage of total spending in this country is and is likely to be in future. Now, the difficult thing that government's going to have is given extra money to people who receive social grants, how do you take it away after 6 months? That's not going to be easy. We've seen already that ANC councillors will kill each other to try and get higher up on the list. Now you go to millions of people, 17 million of them, who are getting higher social grants. How do you remove that? There are all kinds of issues there, but in the South African market, there are certain stocks that will benefit from it. I just said that the banks I'm cautious about, concerned about, because that's a direct bet on the South African economy. Whereas there are certain companies and certain sectors that will benefit from the economy as it is. But if you are sitting with a lot of shares in South Africa Inc. companies outside of those particular areas that do look like they will benefit from the new normal, then your philosophy is very good. Piet Viljoen was saying that yesterday, and I urge you to go and have a look at that, go and watch that, the webinar, the Rational Radio, which we're now doing as a webinar rather than as a radio show, so that we give people the opportunity to ask questions like here. And his point was that with a risk of 20% of the country going the way of Venezuela and Zimbabwe, then as much as he feels that South African shares were very cheap before COVID-19, they're probably even cheaper now, but he still thinks that it's, as an investor, he likes to sleep well, and he would be investing offshore. So I guess the answer there is philosophically or overall, yes, but there are many South African shares which are already international companies to all intents and purposes, And secondly, there's certain sectors of the South African economy, bottom end of the pyramid and construction, which will be outliers on that whole philosophy. I think that's the way I'm reading it now. But let's see what plan Ramaphosa comes up with. Ramaphosa and his cabinet. If it was Cyril himself, I think you could almost bank that plan. But he's got a political party that is still, many of them, stuck way in the past. Some of them is still thinking that the Soviet Union was the best thing that happened to society.
Just on Naspers, Alec, Leonard wants to know, are you buying Naspers shares on web trade in US dollars, or like Kim, sort of in rands with easy equities? Obviously not easy equities, but just the local.
Yeah. No, to buy them through Standard Bank online share trading through the rand. No, they're a JSE. What we decided to do was to bring money back from the US and to take that money and put it into the South African market, because at the time the South African market was starting to look really cheap, and that was in September 2019. So we also wanted to have more of a focus on the South African stocks as well, knowing that many South Africans do have rands, and they either struggle to go through the exchange control regulations to get the money into dollars, or they want to put some of their money into South African stocks. So that was the whole strategy there.
Thanks, Alec. Stefan just wants to know, what about a REIT? I think, I'm not sure how to say REIT, like digital realty.
It's too difficult for me. Real estate, I'm just thinking of where we are. We went into WeWorks. It's the most efficient way of renting space. You don't have long-term leases. You can increase if your staff complement grows, as happened with us. We went from a 4-person office to a 7-person office. So it's that kind of flexibility that you have when you travel internationally. You can go to a WeWork anywhere in the world. Why would you want to take out office rental or office space at a building which is owned by one of these traditional REITs? It just doesn't make sense. I'm just not there. So sorry, and I don't know about the digital REIT that you're discussing now. I hadn't even heard of it until this moment. So to me, property is another one of those in the third file of Buffett's. Too tough to call.
Thanks, Alec. There's a question on Sasol from Miles. You mentioned you don't expect Sasol to go bust. Why, and what do you think is their potential in the next 5 years?
Okay, thank you, Miles, because this was a graph that I put there. Sasol versus the crude oil price. There you have Sasol underperforming quite significantly by about 30%, and that's WTI, which is, you got the ridiculous drop on, remember, on the 20th of April, where it went negative because there were traders who were caught on the wrong side of the trade. But Sasol has still underperformed at its current share price what the oil price is doing. As far as the company is, remember, it's got Secunda, it's pumping out petrol. We as South Africans have not been driving our cars for the last 2 months, but we're going to start driving our cars again from June. And that's where the cash flow comes for this company. The second thing is the investment in Louisiana at Lake Charles has been a multiple of the current price that it's in on the books at. So you've got this asset, which is supposedly state-of-the-art chemical plant, which is worth a heck of a lot more than what Sasol's market cap is. The debt that they have there is serviceable. The management, the new chief executive, Fleetwood Grobler, and the board have taken some very tough decisions. I see in Business Day this morning, they're talking about selling off their service stations here in South Africa to the government. Go figure. But anyway, if the government wants to buy service stations or an SEO wants to do that, who are we to question it? You just work within the parameters that you have. And if Sasol were to do that, it would be another indication that they are raising cash by moving away from the non-core businesses. But really, Sasol is a play on the Rand oil price in the same way as Naspers is a play on Tencent there's a lot more that goes on at Naspers, but actually you're buying Tencent. At Sasol, there's a lot more going on, but actually at these prices, you're buying the Rand oil price. And they have taken out some very, very sensible hedges. I think at around $50 US dollars. Anyway, it's substantially higher than the $30 that we're trading at now. They are a big supplier into the South African market, a big refiner of petrol and diesel here. So it's a very strong business, which has fallen dramatically in value. And certainly at 28 Rand, it was ridiculously cheap. At the current share price, many asset managers think it's an option on the oil price going up in future. And as the world reopens, remember COVID-19 isn't forever. It is a period of time, and it's been 2 months, and it feels like forever. But we will get back to a semblance of normality quite soon with international market. In fact, I should show you some graphs. Let's get out there quickly, and I just want to show you this because it puts things into such good perspective. If you've had the chance of looking yet at this worldometer, but it really works well. You can look at South Africa. There's the cases per day. Let me make this into the full screen. South Africa's cases per day are rising, and that certainly does show where we are in the curve. In other words, South Africa.
Screen's gone. We've just got the two videos. Yeah.
Okay, here we go. Thanks, Stu. Should. Thank you for that. Okay, how's that? There. Oh, now we've gone back to the wrong one. Apologies. Won't be a second. Now you can see our bank with FNB.
Oh.
I think we lost. I think we lost that screen, but there it is. You can see it. Okay. Yep. If you have a look there, you can see that the daily cases. This is South Africa, and on Worldometer, it's a very, very good graph, which gives you the indications of what's happening in this country. Then, if you go to other countries, it is very interesting to see how where they are in the whole pandemic. And the United States, for instance, there you can see daily new cases, which peaked in April. They're starting to fall now, and they're starting to reopen their economy. Similarly, a country like the UK, China, of course, we know has reopened some time ago. But there's the UK, which had 36,000 total deaths. But you can see their cases there too. It's very, very clear that the pandemic, the worst of it, is over in the UK, and you can see it even more clearly on that graph there on the daily new deaths. So yes, COVID-19 has been a source of great concern for people around the world, but it is now starting to, we've seen the worst of it, and as a consequence, things are starting to reopen slowly but surely. People love to watch when you look at this. They love to pick up the Sweden figure. 4,000 deaths in Sweden, relatively speaking, not that great. And Sweden's a very good example because it tells you what happens if you don't have lockdowns. And even there, you can see the daily new cases are falling. So it's worked its way through the economy, whereas the deaths are also falling in Sweden. And those numbers, the death rate as against the recovery rate, is also quite significant. You can carry on all day having a look at those various graphs, but there's also some really good stuff on Biznews, which we're publishing on a daily basis now on the what happens to COVID-19. We call it the pandemic in pictures. It's put together by Douglas Parker, and these are really good. This is really good data. And what I want to show you is just the one graph here, COVID-19 new infections. And there you can see how the UK, Spain, Italy, Germany, and the US is coming into the same situation, but how those infections are falling. So put that all together. Wait, let me do that like that. There we go. That should be a little bit clearer to you now. That's the graph I'm talking about in the middle there, about new infections. And it shows you, unfortunately, the South African graph is still going up. So we know what's going to happen in our country. But I think really the point I'm making is that we will return to normality. It is we're moving in the right direction. put it that way, and the worst appears to be over. So once that comes back, Sasol will sell more petrol, oil price will rise, and we're likely to get to a situation where we might all be kicking ourselves about not buying Sasol at the current share price. I'm just going to go through a couple more, Stu, before we finish off on the questions. There's Apple, which has done better. I took the bottom of the market here. You can see Apple's the black line.
Hey, look, the presentation's not coming through. It's just a blank screen. I'm not sure if it's just my side or for everyone, but I can't see. Yeah.
Thanks, Stu. You see, it's good. The main. There we go.
There we go.
Okay. The Apple and the black graph is the Apple share price, which has outperformed the market generally. And then just to close off with everyone's new favorite stock, Spotify. That guy, Daniel Ek, he's extraordinary. He started his first business at the age of 14. He's really one of those geniuses that is now becoming more and more into the public eye. We've got it in the portfolio. They went heavily into podcasting quite early on, and they've just paid a reputed $100 million to buy the Joe Rogan show, which is the biggest podcast in the United States. And you can see on the right-hand side there, the black is the share price of Spotify, and this one is over the past year. So we got in at just about the right time. Unfortunately, we bought the last tranche recently, but you can see how Spotify is suddenly getting into people's imagination. And then finally, that's Matthew Prince. He's the chief executive of Cloudflare, and Cloudflare is the black line. As you can see, it was only listed last year, but it's heavily outperformed the Nasdaq since the bottom of the market, and it's not surprising because this is an internet stock, the most pure of internet stocks, if you like, given the work that they do. Stu, shall we just complete a couple more questions and then call it a day?
Excellent, thanks. And I got one that's probably good to finish off on. It's from Mark. He says, why do you prefer Naspers instead of Prosus?
It's just a deeper discount, Mark. Simply cheaper. That's all. If you want to go through the estimations of the two, you'll see that Naspers owns nearly 80% of Prosus, which then owns the 31% of Tencent. And Prosus has got a whole lot of other things as well, but it really doesn't matter unless you have, when you compare it all with Tencent, you really are buying Tencent. And if you're buying Tencent anyway, why not get it at the lowest possible price? Also, you can buy Naspers in rands, and that also gives you the rand hedge potential, because as you're getting a 40% discount, and when Tencent does go up, it gets reflected in the rand price.
Excellent, thanks, Alec. That's the last of the questions on my side, so it's probably a good time to call it a day.
It is indeed. Thank you very much again for joining us. We had a big turnout, as we always do, for our Biznews community members. I just want to remind you, we got 2 more webinars coming up this week. It's been quite a busy week. Tomorrow we're going to be talking about offshore investing, focusing on Portugal. And then we will on Thursday be talking about the tobacco industry and all the chaos that's going on there. We've got 3 incredibly good panelists, 2 authors, both not just guys who sat down and wrote books, but they were in the middle of it. Johan van Lochrenberg, who's well known from SARS. We've also got a prof from Cape Town. So on Thursday, if the whole thing with tobacco bothers you, we'll be giving you useful insights there. But just to remind you that we do have every Monday Rational Radio with my regular guest, David Shapiro, in studio. We do it as a webinar, and the reason for that is that we can answer questions. Thanks again for being with us. Until the next time, I'm Alec Hogg. Cheerio.
Thanks, Alec.